Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for August 6th, 2017. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.15 fell from 1.36 last week, yet continues within bullish territory. The total count of securities in bullish or bearish patterns increased 3% to 2,944. The count of bearish stocks increased 13%, while the count of stocks in bullish patterns decreased 5%. The Pirls P&F Market Breadth Summary Chart shows us a market now 10 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, clicking Register, and following the prompt. To subscribe to the weekly Pirls Stock Market Commentary via email free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 125 points for the fifth decline in 15 weeks. At a positive 120.25 points, it continues below the six tops above plus 100, and it continues above all four bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. In a Woody's uptrend since Wednesday 7/19 close, the CCI 20 daily is now at 13.91, down from a positive 55.79 last week. The CCI 20 daily is now within the plus or minus 50 range for another zero-line reject long entry signal should it rise within the next few days. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 66 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. The CCI 20 weekly has fallen to a positive 109.37, down from a positive 133.27 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another CCI 20 weekly trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: oil, banks, brokers, and retail on top. Some tech on the bottom. Bullish, KBW Bank has left the bottom 5. Brokers, KBW Bank, and S&P Retail have entered the top 5. Comp Tech has left the bottom 5. Gold and silver has left the top 5. Bearish, computer hardware and disk drives have left the top 5 and have entered the bottom 5. Oil now leads the top 5. Networkers has left the top 5. Focus this week from www.zerohedge.com. The real dumb money. Retail investors have outperformed hedge funds by 300%. The following are some key points and charts. There seems to be an inverse relationship between an investor's purported level of sophistication and their returns in recent years. At least that's what one might assume when comparing the historical aggregate return of U.S. households with that of the hedge funds community. Using data from the Federal Reserve, Gaurav Chakravorty and Amit Sinha explained in a column for MarketWatch how since 2003, the average American household has earned a greater return on investment than the average hedge fund. What accounts for this achievement gap? The two authors explain that households typically don't invest their wealth like day traders or return chasers. They operate more like skilled portfolio managers who appear to be rational actors. In other words, they rarely adjust their portfolios. The outperformance in household returns is due in part to their savings rate, which allows to build on their investments and higher rates of diversification. Quote, households continued to steadily add to their savings over the study period, and their investments were evenly spread across many different assets, such as stocks, bonds, real estate, and pensions, as opposed to being concentrated in a single asset, such as real estate. End quote. While real estate has historically comprised nearly a third of household wealth, that dynamic has changed since the beginning of the bull market in 2009. Since the crisis, stock market gains have been primarily responsible for repairing household balance sheets instead of real estate. Quote, real estate hasn't driven the repairing of household balance sheets. In the run-up to the 2008 financial crisis, real estate was one of the largest contributors to household wealth and represented about 32% of total wealth. After the financial crisis, real estate has been hovering close to the lowest historical levels at around 24% of total assets. End quote. While this might sound surprising to some, the reason is because stricter lending standards adopted since the crisis have made it more difficult for people to become homeowners. Meanwhile, an increasing number of homes are being purchased by foreigners or by real estate partnerships. Quote, initially, this may appear surprising given the run-up in real estate prices in most parts of the country. However, a further analysis shows most households haven't participated in the latest boom. Bank lending standards are stricter than before, with over 60% of new mortgages going to borrowers with excellent credit scores, as compared with only 25% before the 2008 financial crisis. In addition, an increasing portion of homes are being purchased by foreign buyers and real estate partnerships. When we combine these factors with one of the strongest bull markets since 2009, it's why the stock market has become a bigger driver of household wealth creation than real estate. End quote. Going forward, mom and pop investors should be careful about managing their risk exposure, as a growing share of their wealth is being bound up with equity prices. At 35% of total assets, household allocation to stocks are near historic highs. Before the dot-com bubble, stocks represented less than 30% of total assets, but peaked at 38% during the height of the dot-com bubble. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.